Good day everyone, this is Oliver from Braveheart Trading. In today's video, we're going to talk about how to think like an interbank trader. So, when it comes to utilizing ICT concepts, aspiring traders are often unaware of how their mindset affects their trade selection. And this becomes the downfall of their trading results, often leading them to give up on ICT concepts altogether. However, this issue can be resolved by making better trading decisions. And how we can do that is by adopting a systematic approach to our trades. See, the mistakes that aspiring traders tend to make is they place excessive emphasis on the entry pattern itself. And they might believe that what they see on the chart right now is a textbook setup. Looks perfect. But when they try to put risk on it, they see it fail in practice. And after experiencing multiple failed attempts of textbook setups, but only getting, -1 R, they start to begin to doubt their ability to trade ICT concepts. And over time, this uncertainty turns into wasted time, leading them to blame ICT, and then they ultimately quit, or they search for the new shiny object. So today, I want to demonstrate why the problem is not found in the ICT concepts, but rather in the thinking and the mindset. So today, I want to give you guys and girls a small paradigm shift called the market efficiency paradigm shift. And this will transform how you select trades and experience a significant impact on your journey towards becoming a consistent trader. So, without further ado, let's get into it. So here's what we're going to cover in this episode. First, we're going to talk about demystifying IBDA. So we're going to understand the different components that make up the interbank price delivery algorithm. We're going to talk about the dangers of oversimplifying ICT concepts, which is ignoring narrative, ignoring context. We're going to talk about how to escape the retail trader's mindset, which is the reason why a lot of people are failing to make ICT concepts work for them. So we're going to talk about how to prevent being a retail trader using ICT concepts. Then, once we know what to stop doing, I'm going to talk about what to focus on. So narrative and context is king, how to focus purely on high probability setups, and then we're going to bridge the divide. So transitioning from retail trader to interbank trader. And then after all these topics, we're going to give you a action step so that you didn't waste your time watching this video and you actually got something from it just by taking action. All right, so no productive procrastination here. So first of all, let's talk about demystifying IBDA. So understanding the components of the interbank price delivery algorithm. So before we can do that, we need to understand, okay, what is a system? A system is a collection of interconnected components that work together to achieve a common purpose or function. So if those things work together, we can say the system is functioning, which is system functionality. So this refers to the normal and effective operation of a system where all components work together seamlessly to achieve their intended purpose. But what happens when the interconnected components don't work together? That's when we have a system dysfunction. So this refers to the disruption in the normal operation of a system. So this potentially leads to consequences and failures within the system. So let's talk about some examples of systems, and that would be the cardiovascular system, right? So this is a complex network composed of heart, blood vessels, and blood working together to circulate oxygen, nutrients, and other vital substances throughout the body and maintain homeostasis. So if we have a proper functioning cardiovascular system, the interconnected components work together harmoniously to ensure efficient circulation, delivery of oxygen, nutrients, other vital substances, which overall reduces the risk of cardiovascular diseases for a higher quality of life. What happens when the interconnected components don't work together? This causes a dysfunction in the cardiovascular system, which can result in reduced blood flow, insufficient delivery of oxygen and nutrients to tissues and organs, high blood pressure, increased risk of blood clots, and overall increased risk of cardiovascular diseases. So, how does understanding systems help with demystifying IPTA? So, we must understand that IPTA is a system. A system is a collection of interconnected components that work together to achieve a common purpose or function. So, IPTA is also a collection of components: time, price, intermarket analysis, to help deliver price to the financial system efficiently for the smart money. So IPTA was designed to engineer an exchange premium and discount condition for smart money to hedge position into. So you can see here, this is engineering an exchange premium, and then smart money will hedge shorts into an exchange premium. Once smart money has their position has fully been funded, this will happen at a premium array, we can go to step B. The engineered premium and discounts build liquidity above and below the market, which later on will be utilized for offset distribution. So A engineers premiums, smart money will short into that, slowly hedging into it because they have such large positions. Then, when they are fully into that position, we go into step B, and just the act of A builds liquidity in the market because this is going up, traders are now chasing that up, and smart money is opposing that. So later on, they understand, okay, we built liquidity in the market now. If we entered shorts, we're going to offset distribute all those shorts at the engineered liquidity. So A and B performs market making for the financial system. And whenever you're looking at the market, you're constantly seeing exchange premiums being built and exchange discounts being built. And this is just market making, creating exchange premiums and neutralizing that and creating it sort of like a battlefield for traders to trade within. And this is efficient for smart money only, right? This market is not for us. This is for smart money only. So they're going to create these exchange premiums so that they can make money off it. So now that we understand the system of IPTA, let's dive into the components. All right, what makes it? So we understand that, okay, A, B, C, and it will create an exchange premium and then seek the liquidity, or create an exchange discount, then seek the liquidity. Now we want to understand, okay, how does it do that? All right, what are the components that help do that system? So this is when we, as interbank traders, we want to see IPTA in synthesis. So this means that we're using a bunch of ideas or components to formulate a theory. So what makes IPTA? What are the components? Well, there's time analysis, there's price analysis, there's intermarket analysis. So when it comes to time analysis, this component determines when IPTA is actively operating to market make for the financial system, right? In Forex, it's pretty clear that there's no trading on a Saturday or a Sunday, so the system is designed not to trade on those days. So we can already, that's a clear sign that, okay, IPTA operates on time because it doesn't even trade on the weekends, right? So that is time. Price analysis. This component determines premium and discount valuation for IPTA to market make based on a specific period. So first of all, this is the most important because this tells us a select period to focus on, and then the price tells us the valuation of that select period. For example, the weekly candlestick. Okay? And then we have intermarket analysis, where this component determines how one market, for instance the euro, is correlated positively / negatively with another market within the financial ecosystem, pound sterling or dollar. Right? So if you want to trade the euro in Forex, you're trading the euro dollar, and it's two markets connected to each other, right? Or let's say you're trading the cross, euro pound. Well, that's two markets connected together. Or if it's the 5-year and pound sterling against the US dollar, those markets are correlated positively together, right? So as an interbank trader, we always have to consider all of these things at once. Okay, we're viewing price in synthesis. How this connects to this, how this connects to this. Okay? And the last component of IPTA is the manifestation of IPTA. Okay? So this is why you always hear ICT say the candlesticks is just, there's no magic behind it. It's just the easiest way to view what IPTA is doing. Right? You got the open, high, low, close, which is what we always, it's the periods we need to think about. So this is just the manifestation of IPTA, where we have the power of 3 fractal or the market maker model itself. And if you look at these fractals, they utilize time, price, and intermarket analysis. The candlestick itself is a select period. So let's say this is a weekly candlestick. What would make this candlestick form? Well, we are open. We form a high at a premium array. We seek some sort of discount, and then we close it. That's valuation, right? And then intermarket analysis. We need to see how all of that connects with the other market. Because if the euro is going up, then the dollar is going to be doing something. So an interbank trader has to view all of these components when we are trading with IPTA. And if you're only focusing on this, then you're not really following the system. There's going to be a dysfunction, right? So if you don't consider this, all this could look so beautiful. But this says no, and this says no. So it's a dysfunction in the system. For the system to work, all of these need to work. So now let's talk about ignoring narrative and context and the dangers of oversimplifying ICT concepts. So first of all, we need to know the game. We need to know the liquidity providers. So smart money is a term coined by ICT, used to describe central banks. Central banks have complete control of their asset because it's theirs. It's not ours, it's theirs. So central banks use IPTA, the system, to market make for them because it's efficient. When you're dealing with a ton of money, right? It's efficient, there's no emotions, it's artificial intelligence. And we know how crazy intelligent and artificial intelligence can be. If we're looking at ChatGPT, for instance, that has the IQ of like 150, they say, and Einstein himself had IQ of 160. So what happens when they come out with ChatGPT 10 or something? Well, it's just going to be super efficient at what it does. So that's why these central banks, they utilize these algorithms because, first of all, it's designed completely for their interest, and it's just efficient. All right. So this whole process of using IPTA to deliver the market, it creates an environment for retail traders to trade. So they provide the liquidity to the market because they own it. Like, let's say it's the dollar, right? The Fed owns the dollar. They own the liquidity for the dollar, and they basically can control where the dollar wants to go. And this creates an environment for me and you to trade in. So why is that important to understand? Well, we need to understand IPTA is designed to be efficient only for the smart money. So therefore, we need to create the market efficiency paradigm shift. So the MEP shift occurs when you change how you perceive the markets, how you perceive the financial markets, and how you think to better understand what you observe. Okay? So once you have two of these things, only then are you operating with smart money. Only then are you operating with IPTA. However, if you have been conditioned with retail trading from an early stage, like myself, I used to trade Elliott Waves, RSI, all this retail stuff. I was conditioned to have the mindset of a retail trader. So just because you can perceive the market from a smart money perspective, that's not enough. To make the complete shift, you also need to understand what you see. So it's like reading a book. You have the letters, you understand the letters, but do you really understand what you have just read? If not, then it's just letters, right? So let's take a fair value gap, for instance. You can see a fair value gap, but do you understand how that fair value gap fits in the grand scheme of things? Or can you only see it? Or do you understand why you're choosing that fair value gap? Where does that fit? If you don't, then you're going to find some issues, because there's going to be a lot of fair value gaps out there. There's going to be so many fair value gaps that if you don't understand how that fair value gap fits and everything, you're just going to be forcing a particular bias on that fair value gap when you have to consider every component, as we just mentioned. Okay, so let me give you guys some examples of how people are missing out on this part here. It's because you've been conditioned with a retail trading from an early stage, and you're trading ICT concepts with a retail mindset. So some examples of this would be forcing an ICT entry pattern similar to how you would force a retail chart pattern. Okay, so when I started trading, I remember getting these chart patterns like a bull flag, and then I'd go straight into the chart, and then I'd just force that bull flag on the chart and expect to get paid from that. Well, it doesn't work like that, because you don't know where that bull flag fits in the whole system, right? You're just focusing on one component, which is price. But did you consider the time for the bull flag? Did you consider how that bull flag fits in other markets, such as the dollar, such as the interest rates, bond market? Well, no, because you've been conditioned to force a entry pattern similar to how you would force a retail chart pattern, hence the retail trading mindset, hence using an ICT concept with a retail mindset. So another one is focusing on ICT patterns with no narrative or context behind it. So you might have learned about the power of three, and then you're like, okay, I understand this fractal, and then I'm going to trade that tomorrow. So what you do is the next day you just say, okay, I mark out the open, and then okay, I'm bullish, so I mark out the open, and then I buy below the open. But then you might see that, oh shit, I'm buying and it just keeps going down and down and down. So this fractal doesn't work. I thought we're gonna have a bullish power of three, but the problem is you were forcing that ICT pattern with no narrative and no context behind it. And this is another one I used to fall victim to. I was using the risk to reward tool to determine if a trade is high probability or low probability. So I'd go onto the chart, I'd identify, let's say I identified a setup that looks like this, right? I got the shift, took out the low, fair value gap entry, and then I just put the RR tool, and then I say, okay, that's a 5-to-1. That's a high probability trade setup. But that's wrong because you don't really understand what you're observing. There's all components that you need to consider: time, price, and intermarket analysis. But if you're only focusing on that risk to reward tool to determine if the trade is high probability or low probability, then that's wrong. It's flawed. You're using a retail mindset. So the issue is focusing on the piece instead of the puzzle. So once again, the MEP shift occurs when you change how you perceive the financial markets and how you think to better understand what you observe. So you need to change how you view things. All right, you're no longer viewing Elliott waves or indicators. Cool. You're viewing fair value gaps, liquidity pools, nice. But also, that's just how you read it. But you need to understand what you read, and what you understand what you read has to come from the mindset of an interbank trader, not a retail trader. Otherwise, you're just going to be stuck in between both worlds. So both are required for a market efficiency paradigm shift to therefore find success with ICT concepts. And aspiring traders, the ones that are break even or the ones that can't find any lasting success with ICT concepts, is because they're stuck in between both worlds. Interbank trading with a retail mindset. So we're back here and we have the market efficiency paradigm, and the issue you might be facing right now is you're stuck right here in between both worlds. And you might think that, I'm here because I see these gaps, I see these market maker models, I'm here. And then you wonder, why can't I make this work for me? I see it, but I just can't. And this is what you're lacking. You haven't completely done the shift yet, because you need to understand, you need to read it as well. And that's what I'm going to show you how to do today. So I was inspired to make this video because in my group someone posted this guy's thread. Now I've blurred out his name, but I just want to use his mindset to illustrate my point. And it's not only this guy, but a lot of people have this problem, and I could see because of the amount of retweets, the likes, and the bookmarks. And what this individual is actually doing is he's suffering from a retail mindset, and he was trying to, use ICT concepts, but he couldn't find any success with it because he was just getting overwhelmed. But that's just because you had a retail mindset, bro. So let's go through this together. And by the way, I'm not trying to throw shame on this guy because I was once in this person's position myself. And I was studying ICT, a load, the whole mentorship, and then I was suffering from this as well. But it was only when I really thought about it and how it operates, then I finally got success with ICT concepts. So let's read this. Removing ICT from my trading was the best thing I ever did. Okay? I still trade his concepts. Well, this is the retail where he focuses only on price. One component of the system. Okay? So he removed ICT. ICT stuff is time, price, intermarket analysis. Okay? I still trade these concepts. Okay, so it's probably price. Okay? Because the fair value gap is phenomenal. So, okay. That's already proof that he has a retail mindset. So just to further prove my point, he says, there's simply too much. If you plotted every single PD array on your chart, there'd be a level every 2 to 5 pips, which leads to paralysis for me, and simplicity is key. Well, this guy doesn't understand the fractal nature of price, so that's why he's getting lost in price, and he's getting lost in all these PD arrays. But the reason why he's getting lost in all these PD arrays is because he's focusing only on price. Like I said, if you understood time, then it would give you a select PD array to focus on. Right? You're not focusing on every PD array. Right? It's okay, you're considering price, but you're also considering time, price, and intermarket analysis. And majority of the time, if you blend all those components together for system functionality, it would only give you a select few PD arrays. But if you forget about time, you forget about intermarket analysis, and you're focusing only on price, there's going to be a shit ton of fair value gaps for you. And then you're going to get lost. You don't know what fair value gap to choose, because you're not considering all the components of the system here, bro. You're fixating only on price, which will fix for you if you're watching this and people that are suffering from this. 2, the way he talks about his concepts set false expectations. Thinking you know where the market is going all the time leads to bad psychology, I assume. Well, this is false. When we see a market maker model complete, we don't know what it's going to do after that, to be honest. So that's false. But I understand, because you're trying to prove the point that you're just frustrated that there's simply too much, and you wasted a lot of time studying this and you just can't make it work. But the issue is not ICT concepts. The issue is your mindset, bro. So 3, there's just way too fucking much of it. Take a few of his concepts. See, this is right. Take a few of his concepts. That's true. But you weren't supposed to use all the PD arrays in the matrix as well. I mean, do you have 30 years of experience? No. So you're not using all the PD arrays in the matrix. You just focus on like 1 or 2, what speaks most to you. It could be a breaker. It could be a fair value gap. It could be a liquidity pool. You're taking a few. Yes, but there's not too much of it, because it's just time, price, and intermarket analysis. See, you think it's too much because you're just focusing on price here, and then you're just diving down the rabbit hole of price. And since price is fractal, you're going to get lost, and then you're going to complain it's simply too much, and then simply too much leads to analysis because, oh my god, there's so many fair value gaps, I don't know which one to pick. Well, have you considered checking how time fits into the equation? Have you considered thinking how the intermarket fits into the equation? So, yes, take a few. You got time, price, intermarket analysis. Here, you just focus on what speaks to you. For me, it's the fair value gap and order blocks. That's it. I only pick 2. And liquidity pool. So, basically 3. So, it's not too much. And it's just your mindset. And 4, I agree with you. The ICT community is toxic. But that's why you shouldn't be on social media, with other traders, unless you have a common purpose and you're trying to achieve one goal. See, if you're just trying to have a dick measuring contest, as ICT would say, then you're included in the toxic community. But that's why I've created my community, and it's not toxic at all. It's very positive, and I absolutely love it. So, sorry to hear that you removed ICT from your trading. And I'm not saying that that you're not consistent or whatever, because you could be consistent with flipping a coin with proper risk management. But I'm just saying that this post could have harmed a lot of people that could have been really good at trading ICT, could have had so much potential with ICT, but you prevented that because of your retail mindset, which I want to bring those people back and say, hey, it's just your mindset that was holding you back. And you could be MEP was introduced in month 1, and you could be studying all the way until month 12, but there would be a gap in your understanding because you just didn't think properly about what you observed. So if you went through month 1 to month 12 and you focused on price only, then you'd be very disappointed. And that's why MEP shift is in month 1. So you need to understand this. You need to do this, and then you will no longer have a gap in your understanding, and then everything fits together in the puzzle. So the cure is, how does the piece fit in the puzzle? So this is a piece. Okay? A single piece. Consider this in time. So you see this fair value gap? Ask yourself, all right, I'm a day trader. I see this. Is it London session? Do we have a Judas? Okay? Is it the low of the day? Is it the low of the week? Do we have news coming out later? This is all time analysis for a day trader. Price analysis. Have we hit a higher time frame level yet? Is the narrative bullish? Is institutional order flow bullish? How do I know that this will hold and not become an inversion level? Price analysis. And intermarket analysis. If this fair value gap was to hold, and let's say this is Euro, well, I need to see the same fair value gap on Dixie, and it needs to be a bearish one, right? Or is this going to go sideways because dollar is going sideways? Or can I expect this to trend because the dollar is trending? See, this fair value gap, you can't just focus on fair value gap. Once you see the piece like a fair value gap, you must think like IPTA and consider time, price, intermarket analysis. And then that's how you build narrative behind this pattern. But if you just focus on price, then I could just put up a bull flag here, and it would be the same thing. Or if you just focused on price, you'll see like, oh, that's an engulfing candle. ICT was trading retail patterns all this time. But no, like the magic behind this is not the pattern. It's the time, it's the price analysis, and it's the intermarket analysis, all together forming a system we call IPTA. And all of this makes the IPTA system function. And if you just focused on one, but you neglected these two others, then if this said wrong, then it's a system that function. Why would you take this for value gap then? You need to see how the piece fits in the puzzle. So once again, the market efficiency paradigm shift occurs when you change how you perceive the markets and how you think to better understand what you observe. So this right here is what you perceive, and this is how you understand it, and you combine the both, and now you're trading with the market efficiency paradigm. Now you've made that shift. Now you're trading with IPTA and with smart money. So some tips. Consider all components, not a single component. Okay? An interbank trader views IPTA in synthesis. Everything is connected together. Don't focus on one component, such as price, but consider all components to align yourself with the system. Otherwise, there will be a dysfunction. So, IPTA system. To follow smart money, we must operate within IPTA and its components. View IPTA in synthesis. Synthesis is the combination of ideas, time analysis, price analysis, intermarket analysis, to form a theory. Okay, price is going lower, price is going higher, or follow the system, right? So going back to that exchange premium to seek the liquidity, well, it's all based on time, price, and intermarket analysis. So considering all these components of the system, of IPTA, all thinking, pondering, and analyzing must come from the perspective of time, price, and intermarket analysis. Understand interconnectivity. So to find success using ICT concepts, understand how every part fits the whole. Every part fits the whole. And unlocking price delivery with narrative is by viewing how all components are connected with each other. So you can't unlock a price movement just by focusing on one component, which is price. If you do, IPTA has nothing wrong with that, because it's always correct. But your thinking, that's where the flaw, that's where the dysfunction relies in. Because you might identify a price setup, but you didn't consider the time, you didn't consider intermarket analysis, so there's a dysfunction within the system in your mindset, and therefore you're not unlocking the price delivery and making money. And this one's also key, guys and girls, because the main components have subcomponents. See, price can be broken down into subcomponents, right? And we'll talk about that now. So price can be broken down into a long-term perspective, intermediate-term perspective, and short-term perspective. And it's our duty to consider, when we're looking at price, right, we're considering all these things and how they connect to each other. See, if you just focused purely on the entry here, you just focused on that pattern, you jumped in the chart and that's the pattern I'm looking for, well, you could be shorting in a discount. You could be shorting at the bottom, or you could be longing at the top, because you didn't see where that entry pattern fit in the intermediate term perspective. You didn't see how that entry pattern fit in the long term perspective. So to function, for system functionality for the price, you need to consider the subcomponents of it. And that's made up of long-term, intermediate term, and short-term perspective. So components have subcomponents. For instance, price consists of subcomponents such as a liquidity pool. And don't fixate on a single subcomponent. If you're only considering a single ICT concept, like the fair value gap, but you fail to recognize its place within the larger framework, here, you're still operating within the retail realm of retail trading, which is forcing price. But okay, where does that fair value gap fit in the fractal? So understand interconnectivity. Okay, understand how one piece, like a fair value gap, fits into the larger puzzle of the market maker sell model. All right, that's the larger framework. Okay, so if we know that the market engineered a premium, and now to go down there, it has two stages, right? Whenever you see this fair value gap, you want to blend that with this. So now, for price, we're considering the subcomponents. So we're not saying, oh, price, entry pattern, that's done. No, you're considering all these little subcomponents. The framework, the narrative, then the detail. And if you're missing out on one of these, let's say you fixate on a single subcomponent like this, you forget the framework, and you forget the narrative, then that's why your patterns are not working. Because you don't understand how it all connects. So to unlock fractals with framework, you do this by viewing one component, price, and how it's affected by subcomponents within the PD array matrix. And it's not just the PD array matrix. When it comes to price, you must consider premiums and discounts, and time as well. But this one we're specifically talking about the subcomponents of price, okay, which is what I want to help within, because this subject goes deep. So the main components give you logic, reasoning to operate within, and this gives you narrative. So what are the main components again? We have time, price, intermarket analysis. That is the logic and reasoning. Then we get the narrative from that. Okay, why does the market want to go lower? Oh, because we have bearish seasonals. Oh, because we just hit a higher time frame level from the weekly chart. Oh, because the dollar is going higher, so foreign currencies are going lower. These are logic and reasoning derived from the main components. Then we can build context to work within. So if we know that the market is going higher, how do we frame a specific context to work within? Right? Because the market's going higher, that's too broad. You need context to really focus on, okay, where can I participate on? Because we want precision. So context frames that idea. Okay, market's going higher, but what portion, what framework am I focusing on to participate on that market going up higher? Then, once you have narrative, once you have the framework, okay, you got context to give you high probability trades. And that's how you find high probability trades. So, escaping the retail trader's mindset. How to prevent being a retail trader utilizing ICT concepts. So let's talk about the characteristics of a retail mindset. A retail trader suffers from trading paralysis. A retail trader is narrow-minded. A retail trader is a pattern trader. So I forgot to edit these parts, and I'll edit these parts in the newsletter version of this. But let's go over this, okay? So retail trader suffers from trading paralysis. They don't understand the fractal nature of price, so they get lost in it. And trust me, you can get very lost in it very easily because there's so many time frames. There's monthly, weekly, daily, H4, we go on. And if you're just looking at fair value gap and you see a fair value gap in all these time frames, then you're going to be like, okay, what fair value gap do I pick then? So that's when that's something you need to work on, okay? And I'll give you the solution at the end of this video. A retail trader is narrow-minded. So, like I said, they fixate on a single component, but not all the component. So they're just focusing on fair value gap, fair value gap, fair value gap, but they don't understand it. They don't understand how that fair value gap fits within the picture. They don't understand how that fair value gap fits with time and how that fair value gap fits with other markets. And a retail trader is a pattern trader since they're just focusing on the patterns. So now, let's bridge the divide. Okay, bridging the divide from retail trader to interbank trader. How do you do this? Well, first step, how do you solve trader paralysis? You solve this by understanding the fractal nature of price. So understanding how one piece interconnects with the whole, but also what whole means to you. See, a whole for a position trader is different to a whole for a one-shot, one-kill trader. Or a scalper. See, a position trader's whole it's a big picture, right? And he's gonna hold for months and months and months. So his whole picture is different to a scalper when he wants to get in and get out before the day closes, right? So what does whole mean to you? If you haven't identified that yet, then you're gonna get lost in the sauce of fractal prices and cause trader paralysis. Step 2, understand the fractal nature by gaining clarity of your narrative. Okay, so gain clarity on your narrative. So everyone has a different style of trading and perspective of trading that makes them unique. Larry Williams once said that everyone has a different style. You might dress a particular way. You might like to wear tailored stuff. And your friend might like to wear loose clothing. Well, there's two different styles. You can see it with clothing. So why is it not different with trading? Everyone has their own style in trading. Just like everyone has their own style in cars, watches, food, taste, music. Everyone's unique. So trading's the same way. So what style of trading do you like? What fits your personality more? Are you a long-term thinker? Or you make long decisions? You like to hold positions for a while? Or do you just want to get in, get out? Because you just want to know the result now. Well, then scalping would be for you. So therefore, if everyone has their own different styles, everyone has different narratives. Okay? So what is your narrative? And step 3, with clarity from narrative, gain context. So narrative doesn't give you position. It just gives you like a bias. Market going up, market going down. So to give you position, we need to gain a specific framework. And that framework gives us context. So, yes, okay, we understand, okay, narrative gives us the bias, market's going up. But we also want to navigate that narrative with the precision concepts we're being taught. And we're combining the narrative and context, so directional bias and a select portion of that directional bias for a potential setup. that could frame a high risk reward trade. So narrative and context is king. How to focus purely on high probability trade setups. So let's say you're a one shot, one kill trader. How would you define a high probability trade setup? So your style is one shot, one kill, and you don't like position trading because it's too long. You don't like scalping because it's too intense. You just like one shot, one kill because you just want to trade one setup a week, two setups a week, and bounce. That's it. You don't want to be there in the market, eyes glued to the screen. It's not your personality. You just want to be there when it matters the most, when the weekly range is going to expand, and that's twice a week maximum, 3 times a week if you're lucky. So the one shot, one kill trader, long-term perspective, this is where he gets his narrative from, okay? Weekly and daily chart. And the narrative gives us the logic and reasoning for the framework, okay? So view this like as a top-down analysis process where you're gaining the directional bias where the market wants to go for the one shot, one kill trading style. You're getting that from the weekly and the daily chart. Then, once you understand, okay, the directional bias is up, for instance, then you go into the intermediate term perspective and find framework. So if you compare the 4-hour chart with the weekly chart, you would see that you get more details in the 4-hour chart compared to the weekly, right? So that's why we can frame a better framework. So we know that market's going up on the higher time frames, but due to the details on the intermediate term perspective, we can frame specific context using market structure. Okay, so you can use the 4-hour or the 1 hour, or what I like to do is I just like to blend them. So I look at these 2 time frames and then I come, okay, bullish. And then I look at this and then, okay, this range, focus on, okay? Then when I have a specific range, and then I mark out, okay, premium discount within that range, let's say it's going up. On the 4-hour, I want to make sure that I'm not buying on a breakout, I'm buying on a discount. You understand? So yes, market's going up, but like, okay, how do I frame a high probability setup when the market's going up? Well, I gotta wait until it's going to discount within its 1-hour range. Right? So that gives me context behind the trade setup. And then the short-term perspective is when you look for the entry. Okay? So that's where you identify the trade setup, your entry, your stop loss, and you take profit. So for instance, let's say we're here, #2. We have a range here, and we're looking for a move to clear here. So that's bias says down. Framework gives us this range to work within, looking for a target here. Then, only then, we go to the short-term perspective, so we can refine this move here. This little trade setup from here to here, we can refine it on the short-term perspective. Why? Well, there's more details, but also trade confirmation. See, if it did want to go there, you'll see a setup form. And a nice setup to have is a short-term high, raid, market structure break, and all of these points are triggers. So that raid triggers. Okay, that's a potential setup because it took out a high, then took out a low. Okay, that's trade confirmation because we have a shift. Then entry participation. Okay, how do I participate on this? Well, I wait for it to retrace within a fair value gap. Okay, and all of this is confirmation that this framework is being utilized and that we are in sync with the narrative. Okay, and that, my friends, is interconnectivity. You're looking at how this pattern fits within here and fits within here, which then gives you price. Okay, there's still other things to consider, but this is for price. Okay, this is for entry patterns, and this is going to help you for now. I'll make another video talking about how to consider the other components with time analysis, and that's how to how do you navigate the weekly range, or how do you navigate the monthly range, and we'll use the same idea or thinking for that. But I digress. So I want to give you an example, and this example was taken from this past week of trading, and here was the trade. I was looking for a move here back to the new week opening gap, which is there, and then looking for the weekly premium fair value gap, which is here, for previous week's high, which is here. And after that, I'm not sure what might happen next, but this should give enough framework for bread and butter trading. Okay, so you don't, going back to that guy's post, you don't understand, bro. You don't always know what price is going to do next. You're not trying to do that anyways. You're just trying to find an area where get in, get out, and then repeat. So I understand you're frustrated, but hopefully this video helps you, man. So we have the long-term perspective here, which weekly and daily, right? So we have low here, rated this low, rated this high. So we're seeing this as a consolidation, and it might not want to break this low or this low. It just wants to trade range bound. So I saw this fair value gap as a draw liquidity. Why? Because we're trading in the lower portion of this consolidation, and if the market is cheap, you'd want to seek fair value with a weekly fair value gap here. But how is it going to do that? Well, within this low and this high, we're below 50%, and we've recently reacted off this daily fair value gap. So notice how I blended the weekly and daily, and I built a narrative of, okay, market wants to go here and it wants to go there, but since we're in a consolidation, I don't know what's going to go next, but I don't have to know what's going to go next, because I just needed to frame this to this. That's what you don't need to know if it's going to go with this. You don't have to, bro. All you need is a small move like this to frame a trade-off on. So once you have the narrative, then you can get into the framework for more details. So I forgot to mention that we have a fair value gap here, daily fair value gap. And here, that daily fair value gap aligns with this range. So we're using the market structure on the intermediate term perspective after a long-term perspective level was utilized, which gives us the narrative that, okay, market wants to go here to here, but how's it going to do that? It's not going to go there in one move. It's going to walk there. It's going to create premium, discount, because that's how the system is engineered. So we can see that this daily fair value gap, we can refine that on the intermediate term perspective. So it gives us this one. We can refine it even more with the fibs. So we see how this one's utilized, and we can see how the body is respecting that. And then the 1 hour can give us even more detail. So framework on what? The weekly range, because you're a one-shot, one-kill trader. You want to catch basically the biggest move of the week. Well, you have to consider the weekly candle. So where did it open? Okay. Did Judas? Yes. Why do we expect the bearish Judas here to be bought? Well, the narrative is from here to here. So anytime we see trade below, if we're expecting a bullish week, if we see a trade below that, that's manipulation. Okay, so you have manipulation into the day level, and that's framework. Okay, so now right there we have levels, so that once we go into the short-term perspective, we can look for confirmation that this does want to go higher. So we don't take blind entries off the levels. We have to go down another level for confirmation. So we got the levels and confirmation. So now when it comes to confirmation, What are you looking for? Short-term low, market structure break, fair value gap entry, 50%, Tuesday low of the week. That's the time element of the entry pattern. So if you're looking for one shot, one kill, then you're looking for the low of the week to be in. Well, it happens 70% of the time on Tuesday and at these levels. So we have the levels, trade confirmation, and now using the framework on the intermediate term perspective, okay, we can aim for the new week opening gap first here, and then we aim for that, okay, where does the narrative want to take us, which is about this high. And all of this is a market maker buy model. So bridging the divide, transitioning from retail trader to interbank trader. So adjustments you sought to make in your trading to begin this transition. And first of all, you need to systemize your thinking. Understand that there are multiple, not singular components that affect price delivery. All right, so there is time, price, intermarket analysis. All of these need to work for system functionality for price delivery. And if you're not considering all these components, let's say because you're just focusing on price, then you're not going to unlock price delivery. And then also those components have subcomponents that fit together. So the fair value gap you're picking, like you need to see, okay, where does that fair value gap fit within the picture I'm looking at, or my trading style, or the levels, or does that fair value gap, if it's a bullish fair value gap, does it match a discounted condition? Or is that fair value gap, like, am I buying a fair value gap on a breakout premium condition? So you need to consider components, price, yes, but also the subcomponents of price, such as premium discounts, fair value gap, MF shift, higher time frame level. And then that gives you an idea on price. See, price can't just be boiled down to a single concept of fair value gap. You need building factors around it. And you might see it might seem like too much, but it's not actually too much. Because you have the narrative. So get narrative. Before we can think systematically, you need to know exactly what you're looking for. Are you a position trader? Are you a scalper? See, that's why everyone can be a profitable trader, but just be doing, he could go short, I could go long, and we could both be right, because we just have different narratives in the market. And that's why you'll see a lot in our group, I'll go short, and one of my traders just exited their long. So he just got out his long, and I just ended my short. So it's literally like counterparty A to counterparty B, which is really cool. And get context. So after you're very clear on the narrative, where the market wants to go, you need to be able to frame a solid framework for your trade. Okay, so let's say your narrative for position trader is monthly and the weekly. Then you can use the daily chart to frame a trade setup. You can use the 4 hour to trade setup. But you need to know where you're getting that narrative from. See, if you're a scalper, you'll get your narrative from a 4 hour level or 1 hour level, because that could provide a big enough move for a scalp. But you can't get a big enough trade on a 4 hour level or 1 hour level if you want to be a position trader. So you have to get clear on, like, okay, what is your style, and where would I get my narrative for my style? And once you have that, focus only on high probability setups, which is trading in the direction of the narrative and making sure that the framework aligns with that. So for instance, if I believe that the market's going to go higher as a narrative, right, wants to go up higher, on the intermediate term perspective where I get my framework, I want to mark out a range where it's in a discount. See, yes, the market's going higher, But I'm not going to be buying in a premium. I'm going to be buying when it on a discount, because the market walks to these points. It doesn't go up in one move. It walks. So how does it walk there? It goes premium, discount, premium, discount, premium, discount. So yes, the market's going higher, but you need to go in only at these discount points. And that's how you get the higher lows. And then once you've, let's say you have a range marked out. Let's say you have a specific range marked out, then have a step-by-step criteria to confirm the trade setup. So let's say, all right, I'm looking at this range here, and it's retracing and with a discount. Then go in the short-term perspective, STP, and then look for that confirmation. We should see another break of a high. We should see lows getting bought, and we should see sponsorship to the upside. So, take action. Pick your style for the financial battlefield. So to complete the market efficiency paradigm shift, pick your style for the financial battlefield. Select your trading style, okay? And this will serve as the lens on how you will view the whole market. So if you need help with this, just put a comment below and I'll help you. But basically, it's long-term perspective, intermediate-term perspective, and short-term perspective. One lens is to get the levels from. The other lens is to frame specific fractal market structure. And then the last lens is, all right, I'm going to look for entry to really get a tight stop loss. Okay? And then the second step is focus on a couple PD arrays. So once you have all these time frames, just select a couple PD arrays that speak to you the most, such as the liquidity pool, fair value gap, and then place those PD arrays in the respective time frames, in the respective lens. So let's say you're looking at the long-term perspective, which is a weekly level, a weekly chart. Then start looking for liquidity pools on the weekly chart. Start looking for fair value gaps on the weekly chart. And that's it. You only need 2. Okay? And then when you're in the intermediate term perspective, H4, H1, focus only on the fair value gap. Or focus only on liquidity pool. Or the both. But you don't need every PD array matrix. And then on the ST perspective, the short term perspective, focus only on liquidity pool and a fair value gap. That's it. You don't need to overcomplicate this shit. So with that being said, trading simplicity is the key. And that's the end of how to think like an interbank trader. Hopefully you have enjoyed this, and I'll catch you guys in the next one. See ya.